Fair value gaps are one of the most important ICT concepts, however they are so often misused. Now in today's video I'm going to be running from A to Z how to use fair value gaps, what are fair value gaps. I'm going to give you guys a full breakdown. Now if you want to find out how me and many others make thousands of dollars trading fair value gaps, make sure you guys watch this video to the end so I know you are serious about trading. To start off, what actually are fair value gaps? Now fair value gaps consist of three candles. Now fair value gaps, FVGs, inefficiencies, imbalances, they have a few names on this term, however they all are the same thing. Now we have candle A, candle B, candle C, and you guys can see we have three consecutive candles. And now in this example, three candles, we have three bearish candles, so candle A, candle B, candle C. Now from the low of candle A to the high of candle C, we do have a gap in the middle where there is no wick. This is a little inefficiency right here, as you guys can see. This is our fair value gap. Now what makes our fair value gap valid? Firstly, we want to have market moving with a lot of displacement, with a lot of pressure. So in this case we want to see market move with a lot of sell side pressure, as that is what forms our fair value gap and what makes it valid. Secondly, as stated earlier, market must leave a gap from the low of candle A to the high of candle C, and it would be different in our bullish example. However, in this example, the low of candle A to the high of candle C, there must be a gap. And thirdly, market must not return back into the gap, which would make the fair value gap invalid. Now, if market were to tap into this fair value gap, we cannot use it again, as has already been filled. As for the bullish example, it is the exact same. We have candle A, candle B, candle C. Now, from the high of candle A to the low of candle C, in the middle is our fair value gap. This gap right here is our fair value gap. It is the same, however, it is simply inverted. Now, as you can see, we do have our fair value gap here, which is valid. As you can see, market, we have three consecutive bullish candles moving with a lot of volume to the upside. We have market form a fair value gap, a gap in the middle from the high of candle A to the low of candle C. And as you can see, market does not tap back into our fair value gap, so it is still valid. Now, if we drew our fair value gap out like this, and market has completely smashed through it, there is a chance that it could still be valid if market has left another inefficiency. Now, as you guys can see right here very clearly, market has left another inefficiency. From the low of candle A, candle B, to the high of candle C, we do have another inefficiency, another fair value gap. Now, with our two overlapping fair value gaps, this is what we call a balanced price range, BPR for short. Our balanced price range is our two overlapping fair value gaps. As you guys can see, this is an extra confluence for our fair value gap, and market is more likely to reject off this zone. Now, what can we expect market to do next? We can expect market to come back up into our balanced price range, into our overlapping zone. Now, as you can see, we do have one fair value gap here and we have a second. The overlap is our balanced price range. So from here, we'd expect market to tap into our balanced price range and then react off it. You will never be a funded trader because prop firms are designed to make you lose. There's a reason why 95% of people fail prop firm challenges. I just want to remind you guys that intake for the prop firm passing service is extremely limited, because we can 100% guarantee to pass your funded challenge. I repeat guys, we can 100% guarantee to pass your funded challenge. We are even so confident that you do not have to pay us a single penny until we have passed your account. Remember guys, on the funded stage, you can trade real capital and make real money. Make those withdrawals straight into your bank account. Unlike other prop firms like FTMO, you have to make 15% on your account across 2 stages before you even start to touch a live account where you can start to even think about making profit. This can take months guys, you can waste a lot of money. The average person wastes $2,900 on funded challenges. Don't be this person. We will do the hard work for you and get you funded. Once you guys are serious about trading and ready to make some real money, make sure you guys join the group, the first link in the description, and drop me a message at EMS Capitals. Alright guys, now you are familiar with fair value gaps, you know if they are a valid fair value gap or invalid. I will be going through a 3-step plan, a 3-step strategy on how to trade fair value gaps. Now, this strategy will help you become a profitable trader, and it is so easy even a beginner can learn it. So let's get into it. Now to start off, fair value gaps work on any pair, any indice, anything. So fair value gaps work on all pairs. Secondly, this strategy works on any time frame. ICT does say time is fractal, so the patterns and strategies that work on the 1 minute should also work on the monthly chart. So time frame should not matter for this strategy. And thirdly, to start off, we want to look for a liquidity sweep as our step one. Step one is our liquidity sweep. Now, what do we look for in the liquidity sweep? We want to mark out our significant highs and our significant lows. I want to see if market does break structure and take out any of these highs or lows. As you can see in our example, market has taken out the high right here. This is market sweeping liquidity. So once we get a liquidity sweep, we want to see market tap into our higher time frame PD array. Now, if you're unsure what PD array is, it's things like old highs, old lows, order blocks, fair value gaps, so on. So now, once market taps into this higher time frame PD array, we want to start to see market to reverse in either direction. So as you guys can see, market has been moving bullish. However, we want to see a reversal right here. And to confirm that reversal, we want to see a market structure shift. What is a market structure shift? A market structure shift is a reversal pattern. So if I just bring up my brush right here, say we are forming higher highs. We have a higher high, another higher high, and another higher high. Lower low, no, lower low, lower high, lower high. For a market structure shift to occur, we need to change the structure of the market. We need to change in trend. So as you guys can see, we are bullish right now. However, if market then does change in trend, as you guys can see, we went from higher high, higher high, higher high, and now we're getting a higher low. And we're also getting a lower low. This is market beginning to change in trend. This is our market structure shift. This confirms our bias towards the downside, and it shows us we can now take the market bearish. Once we've gotten our market structure shift should move with displacement, which should ideally leave a fair value gap behind. So once we've gotten our market structure shift right here, as you guys can see, we want to look for the first FVG left behind by the market and want to enter off that fair value gap. Now, I enter off the 50% of all my fair value gaps. Now, if you want to know how to find that out, simply go to settings on your fair value gap and tick middle line. Once you got the middle line, that is the halfway point of your fair value gap. And in 99% of cases, market will come and fill to the midpoint of your fair value gap. Now, after your market structure shift and you've identified your fair value gap, it is very simple. All you want to do is wait for market to enter in towards your fair value gap. Now, market will be coming. You can place your limits, simply walk away from the trade, wait for market to tap into your zone, stop loss above the swing high or low. And as for targets, you want to target opposing liquidity. It's as simple as that, guys. In 3 steps, you can become profitable very easily. I'm going to be showing you guys a couple examples on the live chart, so make sure you guys stay tuned. Alright guys, I'm on EURUSD currently, and I'll be showcasing the first trade where I use the FVG strategy. Now, this strategy is so simple and it managed to catch me a 1 to 5 risk to reward. I caught about 33 pips on this trade and my stop loss was about at 7 pips. So to start off, I'm going to firstly remove all drawings off my chart so you guys are seeing the same thing that I'm seeing. So firstly, I'm going to replay the market to about here. And now for our step 1, we do want to see a break of structure either to the downside or to the upside. Now, what significant levels of structure do I see? I see nice structure right here, and I also see this swing low and swing high. So now if I do play out the market, you can begin to see that market does take out our lows. Our lows get liquidated, where market will presumably begin to reverse as we have taken out sell side liquidity. Buy side liquidity, sorry. And just a reminder for you guys, if we take liquidity to the upside, we want to start to look for sells. However, if we take liquidity to the downside, like we have in this example, we want to look for buyers. So we've liquidated these lows and market has come, taken out sell side liquidity, from which I will presume market will come and reverse. So for me to confirm my bias to the upside, this brings me on to my step 2. I want to look for our market structure shift. So in my market structure shift, I want to look for a market structure shift with displacement. Now, I'm going to wait for this high to be broken with a body closure. Now, you want to see each candle, what the story is of each candle. Each candle tells you a story. Now, if we do get a wick closure above here, however, body just closes below the line, that tells me a story that the wick may want the next candle may move down. This is not confirming my bias properly. This is not a valid market structure shift that you can take. Now, if I do play out market, you can see we do get wick closure. However, as you guys can see, we don't get full body closure. Now, if I do play out market again, you can see if I do outline the next high, which is right here, we do get proper body closure above this high, which is our valid market structure shift. So if I just outline that for you guys, MSS, which is market structure shift. As you guys can see, we do get a full body closure. And if I play the next candle, Market leaves behind a beautiful fair value gap. This is our fair value gap right here. Now, this brings us on to our step 3, as we've got on our liquidity sweep, our market structure shift, confirming our bias to the upside. I want to start to look for my entries now. From here, I just want market to enter to the 0.5 mark of my fair value gap, as presumably most times market will come and fill this. From here, I would simply place my limits and wait for market to tap in to my fair value gap. As for stop loss, below the swing low at about 6.3 pips, I'd give it a bit more room just to play around. As for take profit, you want to target opposing liquidity. Now, I do partial on most of my trades, so I could place my first partial here, second partial here, however, final take profit all the way up here. Now, if I do play out this trade, guys, let me go on to the 5-minute time frame just so you can see it better. Hold on, if I just hop onto a lower time frame for the entry, as you guys can see, amazing entry. How much drawdown were we in? About not even a pip of drawdown, which is absolutely amazing. The reason why we're in such minimal drawdown is as we have marked out the 0.5 mark of our fair value gap, which minimalizes our drawdown. It's absolutely perfect. So I'll hop back onto the 5-minute and I do play out the market. Boom. You can see we do go back to break even a couple of times. However, after that, market does shoot up very quickly, securing us at a nice 1 to 5 in the span of a couple of hours. So it's that simple, guys. You don't need to overcomplicate trading. I see a lot of people complicating trading, complicating fair value gaps. This is why you're not profitable. If you stick to the basics, you'll be a profitable trader. So with that said, thank you guys so much for watching. I hope you guys enjoyed the video today and I hope it was useful, you guys. If you guys want any future vids, just comment down what you'd like to see. And I'll see you guys later. Make sure you check the first link in the description to get funded 100% guaranteed. And with that said, I'll see you guys next time.